Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member. All right, welcome everyone. My name is Ashley over at Campbell Property Management, and it is 12 o'clock, so we are going to go ahead and get started. This is the Insurance Renewals webinar. But without further ado, I'm going to hand it over to Evan Bradley at Campbell Property Management to get us started.
Thanks, Ashley. Good afternoon, everybody. My name is Evan Bradley, one of the partners here at Campbell Property Management. I'm also a licensed CAM, and I do work very closely with many of our largest associations on both their budgets, and a huge component of those budgets is insurance. So, those of you who may not be as familiar with CAM, we have been serving the South Florida market and now have expanded up into the Martin, St. Lucie, and Orlando markets since 1953. And we are the highest rated property management company on Google. So go ahead and check us out. And we do pride ourselves on our renewal rate. We renew about 98% of our contracts annually. So we specialize in on-site property management in particular. So if you are in the market for property management, please don't hesitate to reach out. Joining us today is as special guests Paul Mack and Chad Tiernan of formerly of Mack and Waltz and of Assured Partners. So their team is specialists in HOA and condominium insurance, and they're going to talk to us a little bit about the state of the market and what we can expect going into 2026 renewals. Paul, Chad, you guys want to introduce yourselves and your firm a little bit?
Yeah, sure. Thanks, Evan. Uh, I've been in the insurance business for over 35 years. And as you mentioned, our specialty is community associations. We have over 300 that we insure in South Florida. Assured Partners has over 3,000 in the state of Florida. So this is our specialty. And we look forward to working with you today and giving some information out there that people can use and take back to their communities.
Great.
So we'll just go through the quick agenda here today. We're going to talk about several things. First, we'll just do a little bit of association insurance basics, state of the market. We'll talk about some specific exclusions and warrants to look out for on policies. Roof age has become a massive thing with insurance carriers and a big issue. So we'll talk about that. I'm sure everybody wants to know what to expect for 2026, so we'll cover that. And then a co-insurance example, some electrical panel info, and then what can be done to reduce rates, and then communicating this to residents. And then we'll do a little Q&A at the end. So for the association insurance basics, one of the main questions, what insurance must an association carry, and can they be self-insured? I'll talk about a couple, and then Paul will talk about a few as well. The main, probably the most common lines of coverage you should carry: property, if you have any sort of property to cover, whether you're a condo or an HOA with a clubhouse or other buildings. Property is usually going to be your biggest line of coverage, your largest premium, and sometimes your most important. General liability is another must-have line of coverage. That's going to cover anything like a slip and fall or general, casualty that happens on the property. Directors and officers is arguably one of the most important for a board member who's volunteering to serve on the board. That's going to cover you guys for, volunteering and doing that. And then crime is another big one. That's the theft of the association's money. And that's a massive one that you need to have. And then umbrella is one that, depending on the size of your community, maybe you don't need to have it, but the vast majority of communities that we work with have it. And it's kind of a security blanket that would go over top of some of your other policies if you hit that limit and don't have any more limit on those policies from a really big claim. There's a couple others, Paul, if you want to talk about some of the optional ones that we do have a lot of communities that carry them, but not everyone, like a legal gap policy, a cyber, workers' compensation, and then flood if you're in a high risk zone.
Yeah, those are important coverages. You covered sort of the standard, I guess we would call it, policies that every association has. The legal gap policy picks up legal defense coverage if your general liability or your director's insurance doesn't cover it. So, for example, mold is a big exclusion we see on almost every liability policy now. Um, and the market in Florida for community associations on the liability side is a difficult marketplace. I mean, property is getting a lot better. We're going to get into that a little bit later, um, but liability is tough. So if your association is in South Florida or has experienced some claims, you're probably going to have to buy liability insurance, slip and fall insurance from what we call a non-standard or a non-admitted carrier. And it's very often we see exclusions for things like animal bites. We see exclusions or limitations for things such as assault and battery. And if you're sued and you have a limitation or an exclusion, legal defense coverage will pay the cost of an attorney to defend you. The association will have to bear the cost to settle the claim, but at least you're not completely bare. You have the cost of an attorney, which when you get sued could be significant, 500 up to $800 an hour to have an attorney defend you. So we think that that's a good policy to have. And the others that you mentioned, cyber and workman's comp, they're very inexpensive in the
Oh, did we lose
I think we
Paul?
might be losing Paul here.
Well, why don't you help us, Chad, understand what's the role of the insurance agent and how is it shopped or bid out? I know people ask that all the time. How do I know I'm actually getting the best deal? Because I can only work with one agent.
Right. Yeah. So really, it's a really good question, and it comes up a lot. The role of your insurance agent is basically to be a trusted advisor to help you go to the marketplace and get the best possible deal, like you're talking about. Um, so our job is to work with all the different insurance carriers, go out to market, get as many bids as possible from those carriers, and then present that to the community. We also will negotiate with the carriers to try to drive the premium in the right direction and get as low of a premium as we can get, but also improve the terms. So the role is really just to be a trusted advisor that can go out to the market on your behalf and make sure that you're getting looks from every possible insurance carrier that you can get.
And Paul started touching on this before he dropped off. What is the difference between admitted and non-admitted carriers? We hear that quite often.
Yeah, this is a really common question, and it's a very important one. Admitted versus non-admitted is a big distinction. An admitted carrier is going to be a carrier that's basically that there's two big distinctions. The first one is they're backed by a fund called FIGA, which is Florida Insurance Guarantee Association, and it's basically a state-run fund that every admitted carrier pays into. Where if any carrier that's admitted goes bankrupt, this fund can help step in and pay out claims. Whereas if you're non-admitted, you don't have that backstop. And then the second biggest difference and reason why it's important is because admitted carriers, their policies are more regulated, so they can't just kind of throw in any sort of exclusions or warranties without it getting approved by the state first. So generally, admitted carriers have a cleaner insurance policy, and then you're also, backed by that fund, that FIGA fund.
Right? Another term we hear thrown around all the time is surplus lines. What does that mean?
So surplus lines is basically just the same as a non-admitted carrier. It's just the, non-admitted, non-standard market where you'd have to go outside of Florida and work with a wholesale insurance broker, basically. So essentially the same as non-admitted. Um, This is a big one, the state of the market. Just general updates and common questions. To answer that first one, our increase is starting to slow down. Yes, actually, to the point that now we're seeing decreases, which has been great. The past 2 years in the insurance market, specifically the property market here in Florida, has been absolutely brutal with these crazy huge increases. And last year, we saw that slow down to where we were getting flat renewals, and now at this point, we're seeing decreases. Um, and everything we're seeing looks like it's going to continue into 2026, but we'll talk about that a little more at another point in the presentation. And then what's the impact of inflation on replacement cost values? This has become a huge thing with insurance carriers where they have deemed that a lot of so you get a third party appraisal every 3 years if you're a condo per condo statute, and that appraisal essentially determines the replacement cost value of your building. So you submit that to the carrier, and what we've seen in some cases is carriers will come back and say, hey, this is not accurate to what it would really cost to rebuild that building today. Um, and they're pushing back on that, and they'll do their own replacement cost calculation. And in some cases, you'd have to buy a higher limit than what your appraisal might say. And the reason for that is because of this impact on inflation, on replacement cost values, and property appraisers might not be taking into account, you know, how much more expensive it's gotten to rebuild these buildings. So that's become a big issue with some carriers. And then there are some more carriers entering the market. We're talking about how much the property insurance market has improved. There's several new admitted carriers in the market, which has been great. And there's some more capacity in the non-admitted market as well. Um, Thankfully, in 2025, this hurricane season, we didn't have too much of an active season in Florida, or really just in general in the United States. Um, there were some areas, unfortunately, that got hit, but overall wasn't too bad. So 2026, we're expecting to see the same decreases with the property insurance market continue, and things still look good. Um, Paul, you back now?
Yeah, I'm sorry about that. There's an AT&T guy in the neighborhood. I assume he cut it off,
Gotcha.
but I'm back.
So deductible options are starting to improve. We've seen anything from some carriers are even offering 2% hurricane deductibles. Many of them offering 3%, with 5% still the most common hurricane deductible we'll see. And then for all other perils, we see anything from 5,000, 10,000 as the most common. Um, how about premium financing, Paul? Have you seen uh, premium financing been impacted by high interest rates in the past couple of years?
Yeah, and with the Fed making a cut, we're starting to see a slight improvement there as well, and that is an area that we or any agent can negotiate. So when you're talking about higher premiums, that number when you're looking at the truth in lending disclosure can be a big number, and it's a great point of something that you want to pay attention to.
This is an interesting question that Paul and Evan, I'm sure maybe you've heard from some communities, but can we combine policies across multiple neighboring associations to save money? So if you're in kind of a big master community, is that possible? Paul, I don't know if you want to touch on that.
It is, especially now when the market is softer. There are certain policies that we can look to combine, and there are certain policies that, under any circumstances, you cannot combine. And those policies that should never be combined are the D&O, the director's insurance, because by doing that, you could potentially be voiding coverage. Because if one insured does something to void the coverage, it voids it for everybody. So there's not enough scale in those policies to really combine them and save money. But on the big policies like property and general liability, when you have very close communities, you know, master and sub associations, you can look to combine those policies, name all insureds on one, and it does help when you scale it to save money. Be aware that if one association has a claim, it's going to be on your record. It could affect all. So I think you got to look at the pros and cons and make a decision based on how much money you potentially can save and what the potential risks are or consequences down the road.
And then just to talk about some of the other lines, but we'll get into it for 2026 expectations. Directors and officers and general liability and umbrella. Um, Unlike the property market, these have remained a bit tough, especially the liability market, and more recently, umbrella has become really, really tough. So with general liability and umbrella, we haven't seen this new influx of carriers that we have with the property market, and that's made it pretty difficult. And then the second thing is that uh, claims. So not only just Florida, but across the country, there's been more and more claims and bigger payouts that some people will even call nuclear lawsuits. I've heard that term thrown around. But umbrella has been very difficult, where we're seeing some huge increases. I don't know if you want to expand on that at all, Paul.
Yeah, the term social inflation has really had a big impact in Florida. I mean, look at the cost of everything that's risen in the last 5 years, and you can add the cost of settling claims for slip and falls, where something that historically costs $30,000 to settle is now costing 90, $100,000 to settle. And the plaintiff lawyers, they know this. I don't think you can drive down 95 and go 2 miles and not see a billboard for some plaintiff lawyer looking to sue somebody. I don't think you can watch the local news and every other channel is a plaintiff lawyer. So these are the kinds of things that impact the cost of insurance, because there's a frequency issue of these claims being reported, and the cost to settle them is costing more. So the only way these insurance companies can sustain is to raise the cost of insurance, and that's the single largest contributor to increasing in rising costs. And like you said, Chad, is the umbrella. The umbrella policy is there for a catastrophic claim. God forbid a wrongful death or some serious claim. Your general liability pays $1 million, and then that carrier is done. So the catastrophic consequences of the claims that we've seen, we're hitting these umbrellas more and more, and a lot of these carriers have been very, very liberal in cost of umbrellas. Have been very cheap historically when you compare umbrellas for community associations to other businesses, and those carriers are starting to realize this, and a lot of them are pulling out altogether. Surfside had a big part of that as well. And then, you know, just the environment continues to deteriorate for it. And what we're left with is the carriers that will stay in this market are charging a lot more. It's not uncommon to see umbrella costs double and triple. If you're lucky, you know, it's a 20-30% increase over last year. Fortunately, they're not the largest policy in the portfolio, but if it triples, it'll get your attention. I can tell you that.
Yeah, fully agree in terms of the lack of carriers kind of just allows the existing ones to do what they will in terms of raising rates, and it's unfortunate, but hopefully that starts to change. I know that there has been some legislation from the government in terms of trying to, make it a little bit more of a friendly environment and limit some of these claims. But I guess we'll see how that unfolds. So we talked about general liability and we talked about exclusions. Um, some of the most concerning exclusions are on the general liability policy, and a lot of them are there's a couple. Animal bite is a big one. Assault and battery is another big one. Firearms, abuse and molestation, water damage, and liquor. So these are all things that could be on your general liability policy, especially if you're with a non-admitted carrier. And it's always important to review the full policy with your agent and make sure that you're aware of everything that's on there. And then if there is one of these, sometimes you can get it removed, like for an animal bite, if you provide them a pet policy that's limiting the types of animals and the weight limit of an animal and all that type of stuff. You can sometimes get these exclusions removed. So it's always important to make sure you're reviewing it with your current agent.
Yeah. Yeah. No, so this is where having an insurance agent that understands community associations is very important, because those exclusions that Chad mentioned, I mean, and I said this before, many of the community associations in Florida are going to be written by non-standard companies, which means that they can throw any exclusion on their policy that they want to. They don't have to have any kind of regulatory approval to do this. So your agent has to be looking out for you. If you get a quote and it's very limited information on a proposal and it's a lot cheaper, and there's no discussion of what the potential exclusions are, I would be very concerned. I would at least ask the question, hey, oftentimes people say, well, is this apples to apples? Well, sure, it's general liability insurance, but when you're dealing with non-standard carriers, I can assure you they put exclusions on. And the difference between agents that understand this business and care about their customers will try and negotiate the best that they possibly can. And when they can't, they're going to disclose this, have a discussion, give you some options on, do you want to pay more and have more coverage, or do you want to pay less and take the risk? The decision is yours. A good agent is going to help you and give you options and explain to you what the potentials are, versus buying a policy that you think is the same, and then you have a claim and you get a letter from the insurance company that says, hey, read your policy, we don't cover that.
Yeah, and honestly, the reason they put a lot of these exclusions on there is because they are the most common types of claims and they are some of the most expensive claims. So you really do not want to be without. I've seen particularly animal bite and assault and battery are very common HOA lawsuits, and it may have nothing to do with a staff member or a board member. It's purely just people who live in your community that get into an altercation or whose dog gets off leash. Now the insurance for the association's dragged in. You have no coverage. You may be coming out of pocket. As Paul mentioned, both for defense and any settlement costs. It gets very expensive very quickly.
Yes, yeah, 100%. And that's, you see those animal bites. We see them frequently. Florida, Texas, and California lead the state in animal bite incidents. And some carriers, I think Chad mentioned this, it's just a matter of showing them your pet policy, and they'll remove it. It's a standard thing. They throw it on there. And if your agent isn't on the ball and can get it removed, I mean, we've done situations where we've received a change of agent and we sent in the pet policy and it came off. It's that simple sometimes.
Right.
Warrants is another form of limitation that insurance carriers will sometimes throw onto the policy to try to protect themselves. So, Paul, do you want to do a quick little overview of what a warrant is, specifically maybe like a swimming pool warrant?
Sure, that is the most common. We see, as Chad mentioned, a warrant. Basically, it's a condition in a policy. A typical warrant endorsement will read like this for your pool: that you have functional and working self-latching gates, that if you don't have a lifeguard, that you have the ring, and there are conditions that have to exist. So in some cases, if we have to live with the endorsement, we're going to make the association aware and at least have somebody regularly inspect to make sure that doesn't work. Because if there's a hole in the fence, if the latching gate is open and not functional, and somebody wanders in there and drowns, in my experience of 35 years, if you give the insurance company a way to wiggle out of paying a claim, 100 out of 100 times they're going to do that. And that's the reason they put those those limitations or those warrants in the policy is to protect themselves. And we don't want those kinds of things. And that's why you're buying insurance, is for protection. So we'll try as hard as we can to remove those warrants. We'll tell the insurance company to go out there and inspect it. Sometimes the price that they're giving us, sometimes the association has some claims frequency, some losses, and we don't have a lot of options, and we have to live with this. But you just got to be aware of it and make sure that you comply.
Yeah, I would argue the warrants are almost worse than the exclusions because they give you a false sense of security that you have coverage, and it's very easy for them to find a loophole. I would definitely try to avoid those at all costs.
So this is next topic we'll just touch on here, roof age and mandatory replacement. Roof age has become a massive issue with insurance carriers, and I think that there's a lot of confusion in some cases with homeowners and board members on, when do I need to replace my roof? What determines why I should replace my roof and all of that. Um, so I guess first question is just why do insurance carriers care about roof age? And I think the main reason is because their concern is once a roof reaches a certain, age, it's going to be more susceptible to ripping off during a windstorm, during a hurricane. So it could be a perfectly functional roof that's maybe not leaking, so it's functional in that sense. But as it gets older, average wear and tear will break down the roof and the straps and everything holding it down. And their concern is that roof coming off and then damaging the rest of the building. Is that kind of what you agree with, Paul, or are there some other factors that they're looking at?
Yeah, yes, I would agree with that. And I would add to that the subjectivity of a claim. So go back 2 years when we had this, we had legislation that basically roofing contractors, plaintiff lawyers would contact homeowners and building owners and community associations and say, hey, we can get you a free roof. We're going to get the insurance company to pay for it. If they don't, we're going to sue them. They're going to pay your legal fees. So that created a firestorm, and it basically turned the market upside down 2 years ago. And when I say subjectivity, what I mean is that if there's a loss, there's a big difference between a roof that is not leaking. And this is the biggest objection we get from listening to boards and of community associations, that why should we replace this roof? It's perfectly fine. It doesn't leak. Well, if there's a storm, the insurance company is way more at risk when the roof is old to being sued and being forced to replace your roof. They did change the legislation. They did say that for certain carriers, the insurance company doesn't have to pay both parties legal fees, but that doesn't mean that they're not going to get sued if there's a claim, or a community association isn't going to try and get a roof. And when the plaintiff lawyers are saying, we don't even care if you don't think there's damage, we're going to sue them and get you a free roof. That was the problem. So the market has gotten a lot better. So we're seeing a little more leniency in this case now. But 2 years ago, if your roof was old, you were lucky to get insurance.
Yeah, and kind of to follow up on that, about lucky to get insurance if your roof's old, we still are seeing some carriers decline in terms of roof age. So there are plenty more property carriers in the market, and the ones that are in the market are more aggressive and they're trying to write more business. But at the same time, roof age is still arguably the biggest factor they look at, if not one of the biggest. And they will still decline if your roof is too old in some cases. Um, the difference between actual cash value and replacement cost coverage for roofs is a pretty massive difference. Do you want to just go over that real quick, Paul, and why that's so important?
Sure. Yeah. So, if the roof goes over generally 12 to 15 years, depending on the insurance company, but that's generally when you start to have a problem with this. The valuation when you have a claim will change from replacement cost, which the definition of replacement cost is new for old. It's always going to be like kind and like quality, but it's new for old. And that's what you want. You want a new roof. If you have to go actual cash value, you're going to get old for old. So what they're going to do is they're going to value the roof as a new roof, and then they're going to depreciate it based upon the age of the roof. So you're getting, ACV is going to factor in depreciation, which if your roof is old at the end of its useful life, you could end up with very, very little from the insurance company, if anything at all, because if it's a win loss, remember what we covered on deductibles, you're paying this 3 or 5% of the valuation of the building. So, you factor in that deductible and then a tiny valuation, there's nothing there. There's really no claim. So the difference between replacement and actual cash value are huge. Those buildings that have replaced their roofs are going to be in a much stronger position to leverage carriers because, as Chad said, we got more carriers in the market now. So all those carriers are going to want to bid on this. Whereas if the roof is older, maybe some of those carriers are going to pass or not be as aggressive.
Yeah, definitely a massive thing to look at and make sure you're aware. Is this difference between replacement cost and actual cash value? Uh, do all carriers look at roof age the same? This is a big question, and the answer is really no, to a certain extent. I mean, the general idea is for, in most cases, around 15 years, depending on the type of roof. But if you have a shingle roof, it's usually 15 years. With a flat roof, generally they're 10 to 15 years, but they're almost looking at it just by condition, and they'll use their own satellite imagery and everything to look at the condition of that roof and see what it's looking like. Um, if you've got a clay or concrete tile roof, some carriers will give you 25 years of useful life, but again, some will only maybe give you that 15. It really is by the carrier basis. And then with metal roofs, some carriers will give you up to 30 years of useful life. So at the end of the day, it does differ between the type of roof, but at the same time, each carrier has their own set of guidelines that they kind of look at. So we'll just go over what to expect in terms of 2026 for the property coverage. This is probably the biggest question with everybody is what should we expect for 2026? Are we going to get a decrease? What's that looking like? We broke this into two separate sections. So the first one is all about property coverage, and it's kind of like the condo perspective. And then the second section will be all the other lines of coverage, and it's more so HOA focused, um, just to give two different sides because it really is a big difference. So for property coverage, we already briefly talked about this, so I won't spend too much time, but the valuations and replacement costs. We're seeing those values skyrocket. We're seeing carriers use their own replacement cost valuations if they determine that the appraisal is too low. So that's still happening. But in terms of terms, like we talked about, we're seeing better wind deductibles. Um, Carriers are still requesting the 40-year recertification reports for the buildings that need them. So if you don't have that done or you're in progress, that's going to be a big thing when you go up for renewal. The carrier is going to be asking about that. And if you have outstanding work that needs to be done, sometimes it's very difficult to get competitive quotes from other carriers, and you might just be left with the current carrier that you're with. Um, and then roof inspections, some carriers will, if your roof is over 15 years old, they might require that you send them a roof inspection. Some carriers might not ask for it. Again, it kind of depends. Um, Premium changes, though. This is a big question. Generally, we're seeing on average, most carriers, property carriers, are offering 10 to 15% of a decrease just right out the gate. And that is if you don't have many claims, that's if you're pretty clean on claims, and you don't have, like a horribly old roof. But that's just kind of the average that we're seeing. Paul, is that kind of concur with what you're seeing, or is there more to that?
Yeah, yeah. I mean, this is a big issue that you've covered, and I just want to, in the interest of time, I just want to go back to the valuation for a minute because we get asked all the time to do an evaluation of an association's program, and what we do is we try and benchmark rates with other associations that we see. We'll break down the cost of the association's insurance premium per $100 of the amount of insurance that they're buying for their building. So when we look at that rate, the other very important component of that to look at is the valuation per square foot, because insurance companies go, if you're lowballing your replacement value, because remember, your rate has a direct correlation to the amount of insurance that you buy. And in all policies, you've got to buy at least 80% of the replacement value. You got to do an appraisal. Some of those appraisals aren't worth the paper they're printed on. They come up with a number that's just a number. It's not real because construction costs have risen dramatically in the last 5 years. So we'll look at that number, because if the insurance company is not comfortable with the replacement value, they're just going to jack up the rate. So they're going to give you less coverage and charge you more money. It doesn't make any sense, but that's what's happening. So just to kind of put some of that into perspective with the premium range and what we're seeing, you've really got to take a hard look at the valuation, because if it's done properly, the insurance company goes, well, yeah, we are going to lower the rate. And that's something that they're uber focused on right now.
Yeah. No, I'm glad you brought it back to that, because I think one of the most common questions in the registration that we got was, if I have to just select one agent, how do I determine, I'm getting the best deal, and how do I make sure of that? And this rate that you're talking about is that exact way. So we can offer a review, or any agent can offer you a review and kind of like an estimate of, this is where your current rate is and this is where it stacks up relative to the rest of the market. And then, from there, can it be improved based on, what carriers we can go to, what your roof age is, all of those factors. But that rate is the most important way to kind of benchmark your association's insurance premium compared to another's. And like you talk about, the replacement costs is a massive part of that. So it's always important to, that's how you can kind of benchmark it. I guess to talk a little bit more about the premiums, and what we're seeing, 10 to 15% is kind of the average of what we see. But with some communities, I mean, we've seen much larger decreases. And really, at the end of the day, the big reason is they had more carriers that were willing to quote for their property. So if you've got several quotes, that gives your agent a little more leeway to be able to negotiate a better deal, and kind of create some competition between these carriers, because they all want to write business. So they're willing to, drop the premium or improve the terms, if that means they can write it right now. So, for some communities, we are seeing bigger decreases, especially if you have improvements like a new roof, or impact glass. And for condos that have EIFs, we're still seeing declines, and some other affected items. So, if you have large amount of claims, and very frequent claims, then that still could be an issue. But overall, the market's just in a much better spot, and everything we're seeing looks like it's going to continue into 2026, which is good to see.
Yeah. Yep. The only thing I'm going to add to that, Chad, is fortunately for everybody on this call, the last 2 years of really hard market is clearly over. And in the 35 years I've been doing this, I've watched cycles go up and I've watched cycles go down. So this doesn't surprise me. This last cycle was the hardest that I've seen in my career doing this in Florida. I mean, Andrew was super hard, but this was a really hard cycle. What did surprise me is how fast it rebounded. In talking to the industry colleagues, data is way more readily available, and insurance companies were going to become much more disciplined about sustainability. And, that didn't happen, which is good for consumers because I think greed is something that motivates insurance companies when they get capacity and they can write business. And in Florida, the unique thing is what drives premiums are the reinsurers, the insurance for the insurance companies, because most of the companies that we deal with in Florida are smaller companies that have to go out and cede off a lot of that risk. And when they get capacity, they get aggressive. And that's what consumers want. They want competition. So this is a time to take advantage of that. And that's when having an agent that understands this and that can leverage that for you is and does that effectively makes all the difference in the world.
Yeah, 100% agree. Just talking about some of these other lines of coverage, general liability, directors and officers, and umbrella, we've mentioned those. For an HOA, these are going to be your biggest, unless you have a large clubhouse or some other sort of property that you're covering. But condos also have these policies, so this applies to both. Um, with those, as we've talked about, there's not as much of an influx of new carriers that we've seen. There's fewer options in Florida, fewer admitted options. Um, so we haven't quite seen that improvement yet. We're still seeing increases with all of these policies. General liability on average, we're seeing 5 to 15% without claims, and then with claims, it could be more, depending on each claim. Uh, Directors and officers, it's roughly the same as general liability. It could be a little bit more in some cases. We've talked about Surfside, we've mentioned that. Now Florida has all these new laws that they're requiring boards to, fully fund reserves and all that. So that's kind of played a role in the directors and officers market a little bit. Uh, but there's still, not as many carriers. And then umbrella is what we've talked about, where we're seeing increases anywhere from 10 to over 100% if you have claims.
Yep.
And it's unfortunate, but there's really just not much that can be done because there's really only two admitted property or umbrella carriers that are operating in the state right now. And one of them, isn't writing in certain areas. They just stopped writing in Miami. We had an account that they weren't going to write for. So there's just not as much option in terms of umbrella. And, we've talked about the reasons why.
Yep.
Um,
Yep. Just one thing to add on this, Chad, to everybody on here is if you're looking at your general liability proposal from your agent and he or she isn't talking about those exclusions that we spoke of, it's a one-page summary and doesn't have a lot of information. I would encourage all of you to ask the question, can we see a list of the exclusions and the terms of this proposed policy that you're recommending? And if you're not comfortable with that answer, get a second opinion. You don't have to sign an agent a record to get a second opinion. You can call somebody like me or Chad, and we'll give you a second opinion on that. But it's very important to make sure, especially if the price is half of what somebody else is offering you, and there's no data, no detail about what you're looking at, and you ask the question and you don't get an answer you're comfortable with, get a second opinion.
Yeah, even if you can't get it removed, you should know what's in your policy and what specific limitations are there, because that way you can better protect yourself. So, like Paul's talking about, it's a great question to ask. Is just what specific exclusions and limitations do we have? And you should be able to get a full explanation of everything that's in your policy and if there's anything to be concerned about.
Not all policies are created equal. Not all agents are created equal. Apples to apples is just a word that anybody can say, and you're going to really test it when you have a claim. So you have to trust the people you're dealing with.
Yeah. That's at the end of the day. I mean, trust is
Yep.
everything with
Yep.
you're buying a piece of paper that says they're going to come
Yeah.
deliver and pay for a claim. So you gotta
Trust
know
and
what you're
confidence is
doing.
everything. And unless you want to read, hundreds of pages of insurance policies yourself, then confidence and trust in the person who's presenting this to you is very important.
Yeah. So this is a kind of a random example, but we've talked about the property policies and replacement cost valuation and why that's so important. Um, So co-insurance can be a factor if you're underinsured, if you're not insured for the right replacement cost amount. And it's basically a clause that insurance carriers will put in the policy that says you need to be insured to this amount. So, um, Paul, do you want to go through this co-insurance example and try to explain, why it's so important to make sure you have that up-to-date appraisal so that you're not at risk of something like this?
Correct. So coinsurance is basically the formula is what you do carry over what you should be carrying or what the policy requires you to carry. If you're not in compliance with that coinsurance penalty, and I'll try and explain this in English so that everybody kind of understands it, the difference becomes the penalty. Okay. So in the example here, we're not insured properly. We're 66% after the penalty, right? So you can see after our deductible, what's paid. We lost $340,000 of a potential claim because we weren't in compliance with the policy's coinsurance provision. It's done to protect the insurance company. The rate that the insurance company charges is actuarially based on the policyholder buying at least 80% minimum of the replacement value. If you buy 90 or 100%, they discount the rate. But they have to be comfortable with that valuation. And if you are, you're going to be in a better position to negotiate. If you are, your agent is going to be able to eliminate coinsurance altogether. If the insurance company says we're comfortable with this with the cost per square foot, the valuation, they're gonna waive their right to a coinsurance clause, which takes all the risk for you off the table. If there is a coinsurance clause on there, that is an indication that they're not comfortable because the way the market is now, they're almost all willing to remove it if they're comfortable with the valuation, unless your agent just didn't ask.
Yeah, you'd want to be looking for agreed amount is the term when they agree that, this is an accurate replacement cost for your policy, you'll get agreed amount, but otherwise you'll get either 100% or 80% coinsurance if they don't.
Yep.
So
Yep.
that's what you'd want
Agreed
to look
amount
for.
effectively eliminates the carrier's right to enforce this penalty.
Yeah. So real quick, don't spend too much time on this one, but electrical panels has become a big thing, and we'll just go through the couple that they look out for. FPE, which is Federal Pacific Electric stab lock panels, and Zinsco panels are two that insurance carriers have taken some issue with in recent years because they frequently cause fires and have kind of just been discontinued because of that, and they're outdated and have had issues. So insurance carriers will always ask if any community has these panels, and then if you do, you might have to take some measures to replace them. Sorry. So if you're built within the years listed up here, you might want to check if you haven't checked already to see if you have them, because it's become such an important thing. If you have any questions about them and what specifically look out for, you can just ask us and we can help you. Um, and then how can we reduce rates? In this case, in the current market, how can we get the best possible deal and get the biggest decrease, is kind of what we'd be looking at. Um, some of the building improvements we've already talked about, a new roof is massive, and that gives you a lot of opportunity to be able to go to different carriers. And if you have a new roof, most of the carriers in the market are going to want to offer you a quote. Um, and then one important one is impact class. So if you get full Class A protection on all of your openings on your building, generally carriers, they'll give you a discount. They'll give you a 10 to 15% discount. So that can have, a big impact. Are there any others I'm missing, Paul, maybe that I'm not touching on?
No, I think you covered the big ones. The one thing I would just add to this is the confidence that an underwriter has in so we send in submissions. Underwriters and wholesale brokers get hundreds of submissions. It's not about just slapping information on a piece of paper and sending it out. It's the relationships that your agent has with the underwriters in the marketplace has a lot to do with this, and the confidence. So if you're dealing with an agent that has this specialty, has the relationships locked in place, has a longstanding history, then there's a greater ability for you to see a more effective program that's negotiated. And I think that that's hard to quantify on a piece of paper. It's something that you as a community association have to choose an agent that is going to bring you the best deal. And that's something that's hard to quantify. But it exists, and it's an important thing when you're trying to negotiate on behalf of your customers.
Yeah, would fully agree with that. Getting on the phone with an underwriter and really explaining why, what type of shape this building is in and why it'd be a good account for them to have is
Yep.
something that not every agent does. So it's important to have an
Right.
agent that's taken that extra step and has good relationships with these underwriters,
Yep.
that's been in the business for a while.
Yep. And I mean, as a community association, shotgunning this thing out to calling, 3 retail agents in and having everybody rush to get it out to the market does not put you in the strongest position, because, look at it from the insurance company's perspective. They're seeing this thing and they have to triple the amount of work that they do to get something written. They don't want to do that. They'll see something like that and they may pass, or they may not put a lot of effort into this because they don't have any confidence that they're gonna see any fruits from their labor. So it's important from your perspective that you understand how the insurance game is played. And if you do understand that, you find an agent that you have confidence in, let he or she run with this and bring you the best program, because they are going to be much more effective than they are trying to race to the market to beat some competitor out, or trying to convince an underwriter, even though they've seen this from 2 other agents that put some effort into this because I'm going to get this. That doesn't do you any good.
Evan, do you want to talk about this one? Kind of how do we communicate this to residents, all this knowledge and everything that we've discussed, I guess?
Yeah, I mean, the good news is condo insurance in particular, property insurance is coming down. But anytime you want to educate people, have professionals deliver the message. People should hear from their insurance agent if the policy did go up, if you have an open claim, perhaps why the policy is increasing when maybe some of your neighbors were getting a decrease. Let the professionals answer the questions. You, as board members, don't need to become the insurance experts. It's very hard to learn this topic and then try to repeat everything to your residents and hope to get it all right. You can't learn it all quick enough. So lean on people like Paul and Chad. Your agents should want to come to these meetings and should want to help your residents understand. And I know people are still put off by the price, particularly of condo insurance, but of all insurance. But at the end of the day, when you divide up the cost of the insurance across every unit in your building or all the homes in your association, you'll find out it's actually a pretty good deal. If you were in a single family home, you'd be paying substantially more to live on the beach or live near the intercoastal or wherever you live for insurance relative to your single family. So you're paying a lot less than your single family home neighbors. So always keep that in mind. It's still the best deal in insurance. So we do have a few minutes left. We did have a few questions here in the Q&A, so I want to try to get to those. Um, Someone asked about liquid silicone roof coatings. This comes up, I think, every year. How do the insurance companies look at these liquid silicone roof coverings? Do they actually extend the life of the roof? And how does it help with wind mitigation?
So to answer this one, it's a really good question. If you're just putting the liquid silicone covering on top of an old existing roof, and not removing that roof, they're not going to look at that as a new roof. Um, and you're not going to get the credit for a new roof. If you Because there's certain kinds of these silicone roofs where if you rip off the entire roof and rip off the old existing roof and then you put on the new silicone coating as the new roof, as long as that's an approved roof in Florida, there shouldn't be any issues there. But if you just put this coating on top of an old roof, they're not gonna look at it as a new roof.
No, if you understand what I had discussed before, that the insurance companies are more subjective to being dragged into a claim to replace the roof. There's a difference between a roof that doesn't leak and a roof that's old. And putting silicone on an old roof does nothing to mitigate the risk for the insurance company.
Someone wanted to know, what is the approximate cost of those legal gap policies you talked about?
It's about, depending, there's a surcharge, but I'm going to say it's about $50 a door, $40 to $50 a door.
Right. So for 100 units, you're looking at $5,000. Did I get that right?
Yep. Yep. Yeah. $4,000 or $5,000. Yep. Say 3 to 5,000. I mean, I'm just giving you a ballpark number.
1,000 per 100 units. You guys can do the math.
Yeah.
Can a condo board member perform non-paid handyman work? And that might be a more important question for your attorney or management company. But if they were
Yeah.
to get injured, I think this is a good time to talk about those, if any, policies, Paul.
Yep. 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 Yes, it is. So, workers' comp, it's a $600 policy, the best value in your entire program. It does cover volunteers as long as you have a volunteer endorsement, which you should always, because it doesn't even change the price. It would cover that board member who is non-compensated for an injury. So very important policy to have. All associations should have it. Very, very few decline it just because it's so cheap and provides so much value.
Let's see here. So we just went with a metal roof in our community that's stated as a 40-year life. How's the insurance company going to look at that relative to the age of the roof and replacement?
Yeah, so some will look at it differently. As you mentioned, they kind of all have their own set of guidelines, but a lot of the admitted carriers give you roughly 30 years on metal roof, which is more than, a shingle roof or a tile roof where they'll give you 15 or 25. So 30 is generally what I would say, but they all have their own opinion.
Yeah. And as you get closer to the end, depending on where the market is, will be dependent upon, what is available in terms of how many carriers are going to bid and what kind of coverage you can get, actual cash value versus replacement cost. But yeah, you definitely, a metal will get you longer than shingle or tile.
All right. Can an admitted carrier decline based on age of building? Our building was built in 1975, so 50
Yep.
years
Yeah,
old.
that was a big thing before. We're seeing it now where admitted carriers are opening up their capacity a little bit and they're willing to write for older buildings, whereas earlier, like American Coastal at one point, they were saying they were not writing for anything lower than 1990s, I believe, or 1995. But we're seeing now that they're opening up a little bit with that. But there are still circumstances where they're going to decline based on the year bill.
For the electrical panels, do we need to change out the entire panel or just the circuit breakers?
The panel. It's the panel that's the hazard.
Okay. Can you explain how a property policy works that has 25 different carriers on the policy?
Mm-hmm. Yeah, you want me to cover that one, Chad?
Sure, yeah.
Okay, so if where you're going to have what we call a layered or a towered program, you're going to have carriers that are doing a quota share. So there's going to be a lead carrier. So let's just say it's a big community and the sum of all of your policies are $100 million of value that you need to get insured. So you're going to have a primary carrier that's going to do, a $5 or $10 million primary layer. They're going to be they're going to be the first, they're going to be the front line. And then you're going to have layers after that. And you could have as many as 5 or 10 carriers that are going to take a layer, and you're going to have the first 5 million with one carrier, and then you're going to have another 5 million with another carrier, and then you have 25 over that 10, and so on and so forth until you fill the entire quota. What we're seeing now that the market is getting better is we're seeing a lot less layers, where $100 million, $150 million valuation that we needed to fill took 12 carriers. We can now fill it in 4 carriers, and rates are coming down. Just so we're seeing that more and more. You're not seeing where you're going to have 25 carriers anymore.
Yeah, that would be for a surplus lines or a not admitted carrier too.
Yeah.
Just
Right. Good point, Chad.
Someone asked, how do we find out if we have cast iron plumbing? That's really a management question. Your property manager should know, and if they don't, certainly your plumber would be able to help you out there. Best way to change it, there's some different things you can do. There's pipe lining now that you don't actually have to change it. You can line the inside of the pipes, and there are companies that can do full-on replacement, but either option is very expensive. Um, you will need to do it. You can get dropped by your insurance carrier, and you can be sued for not maintaining the building properly if you have too many leaks. So definitely don't
Yep.
ignore that problem.
Good point
Uh,
too, Evan, is to make sure that communities know what they're signing when they're signing an application. If you get a DocuSign and you just sign away, I mean, a lot of these applications, they ask you, is there cast iron plumbing? Do you have these electrical panels and things of that nature? That if the carrier gets a claim and they can say, well, you signed this application, you told me that you didn't have any cast iron, or you didn't have any polybutylene, or you didn't have any this or that, they could go down the road of misrepresentation.
uh, Someone said about dogs guidelines. So the dog problem is not something you can resolve through rules. Anyone can bring in just about, well, literally any breed, any size of animal, as long as you go through the proper service animal or support procedures. So no matter what rules you put in about dogs and guidelines you have, it doesn't really matter. They can get them in through their ADA, application. So unfortunately, you just need to make sure you have insurance for these things, and you do have the rules that you are allowed to have in place that you can enforce, and you should work with your attorney on that. Can you change insurance in the middle of an insured year?
Not really, unless there's a really, really good reason. Underwriters don't like it. There's penalties to cancel something, even though you're paying it monthly. It doesn't happen very often unless there's a really good reason for it to happen.
Does this count toward our board continuing education requirement? No, this is not a certified course with the state. This is an informational course. We will, if you go to campbellevents.org, that's campbellevents.org, you will see courses that do have CE credits, and those will be clearly delineated on there. But this is just an educational course. So thanks for attending. I've heard this one more recently. Are you seeing any restrictions or insurance requirements related to electric vehicles, e-bikes, e-wheelchairs, or other lithium battery exposure and procedures? There have been a couple of fires, I think, that have resulted
Yeah.
from lithium batteries in buildings.
Yeah, not enough. You're right. There are those incidents that have occurred, but we haven't seen enough of those to where it's moving the needle and underwriters are starting to put exclusions or things on there yet.
yeah, that's something that we haven't seen in terms of exclusions. I know that there is some policy that can cover the standalone EV charger if somebody wanted to buy that, but it wouldn't cover like liability resulting in a fire. Your liability policy is going to cover that, and we haven't seen any sort of limitation.
Right. I think we got through all the questions there. Any parting words for our guests today, guys?
Chad, you go first.
Yeah, thank you first off, everybody, for joining. Thank you, Evan, for having us and going through all this stuff. Our contact info is here. Feel free to give us a call if you have any questions or you want us to do a review on your policies. Um, like Paul and I talked about, we can give you, while you can only have one agent, we can give you a second opinion and kind of just a review. So feel free to reach out with anything, and thank you for all your time.
Yep, and
Said it
from
perfectly,
Campbell's,
Chad.
guys, for attending, our contact information is up here. So if you want to reach out to either one of us, please don't hesitate to do that. If you do want to attend future courses, again, campbellevents.org is where you can find all of our future courses. We will be posting courses for CEUs, and we also have board member certification courses for those of you who are new board members and need to take that course within 90 days of being elected. So thank you all for coming and look forward to seeing you on a future webinar. Have a great afternoon.
Thanks for watching. For more great educational content, click the subscribe button now.